Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. It is March 18th. We're having an awesome day. It's post St. Paddy's Day. I hope you got some green beer yesterday. I know I got a couple of pints of Guinness in out with my friends, so that was fantastic. Remember, everything we talk about here, not financial advice in any way, shape, or form. It's just what's going on in the market. I'm a trader, been a trader for a long time now, back to 1996, which is kind of getting crazy. Next year I'll mark 30 years. For me, I'm starting to feel a little bit old in this grand scheme of things, but let's get into questions. If you're watching from afar, please let me know where you're watching from. I would love to get your questions in early so we can get to the screens and take a look at what is going on in the markets. We're going to pull up the 1 minute chart on the S&P 500 today. This is SPX we're looking at. SPX down 1% today, marking $5,612, down 1.1%. We can see that we're a small gap down past the bulk of the trading from yesterday. If we look at the last couple of days, our point of control is around 56.39. We're currently trading below that, very much below the kind of range from the last few days. But overall, if we scroll back a little bit further, you can see that we're trading right around the point of control from the last couple of sessions. So we have had, this was late last week, we saw Thursday drawdown, Friday a bit of recovery, Monday a bit of a push higher, and now some consolidation happening. Really starting to wonder what is going to go on in this market. Let's take a look at, let's do the 1 day here and just take a look at where this is. I'll delete that little guy off there. We've got, if we look at kind of what is going on, I drew this blue line recently. This is like our 200-day moving average. We could still be in for a considerable drawdown. You know, there's a lot of people that are looking at the market in a very unfavorable way. And thanks, James, for letting me know my audio and video is good. Appreciate that. And hi, John. Thoughts on Chinese company Beyond? They're an EV company. We'll take a look at that. And Kevin says hello. Welcome, everybody. Just in general, when we look at these sell-offs, I know I've got a lot going on my screen here. When we see a drawdown of that kind of 10% range, which is what we've seen here, we saw this bounce off the right smack on the 10% level. Can we go down further? Of course, there's always a chance that we can. You know, a lot of political tension in the world right now. So there is a chance that we could go further down. What we have to focus on is the long term. You know, are there good plays here? Are there stocks that are worth buying? If we look at some of these individual names, I mean, Apple is basically trading at a level that we saw last June. So there's an opportunity. You know, everybody was very, very happy when they had made a lot of money on Apple over the last half of last year. And is there opportunity again for a repeat of that? It may not happen. It may go down. And, you know, that's one of the beautiful things about being an options seller. So what I'm doing right now, especially with the VIX high, if we take a look at the VIX level, 2168, and I know I talk about this quite a bit, but the reason that I do is anytime the VIX is above this red line, and especially above 20, that's kind of the real sweet spot. Whenever VIX is above 20, which it has been for the last month, this is a time where selling premium can make us a lot of money. We can get a ton of theta decay from the volatility being high and the volatility contraction that occurs, because as time goes by, the volatility always contracts from any event. Now, it doesn't mean that a future event isn't going to occur and that the VIX isn't going to spike, but we are in contraction mode right now. I made a nice little article on my blog post. If you guys haven't checked that out, you could head over to my website, drawbridgefinance.ca. You can see the blog that I wrote last week about VIX and specifically about which strategies are my favorites to implement during high volatility. If you're not on the newsletter, also at drawbridgefinance.ca, you can just sign up for the newsletter there, and then it gets delivered straight to your inbox. So I only send out newsletters like once per week on average, and I usually have some really try to keep it, you know, try to keep the value up and make sure that everything that I'm putting out is of high value for you guys, because I understand that we're all busy and I don't want to like flood your inbox. I'm not one of those people that sends out a message every single day. So just so you know, I hate those newsletters, so that I can't be that person that does that kind of thing. What else are we going to talk about? We're going to look at Beyond, and if you have some questions about any other stocks, please let me know, and we will get into that. Looking at the, whoa, I'm pushing all sorts of buttons here. Let's push that button. NQ down 0.7% at 19,687. We should take a look at that chart as well. We are seeing some recovery off of last week's lows. This is the 1-day candles, and this could be setting up for a further leg down. Could be a rally. We just don't know. Neutral plays are my go-to right now. Russell has been hit pretty hard. We broke out of this range. If I was to move this now, where, what is going on? Are we going to see this kind of action? Really closely watching this 200-day moving average. That's going to be very important. If we get back up to that level and we break out to the upside, that will be a positive move for the stock market. Not really sure if that's going to happen. We will see as this continues to go. IWM, same sort of chart. We've got a continuation here to the downside, a little more specific on this, but we're definitely in a downward channel on IWM. What else do we have? Tesla's been hit quite heavily from its highs back from the election announcement. So down at 221, very much in a range where I'm considering loading up on positions. This is where there's tons of premium in Tesla. So for options, premium sellers, it's a great little play. And I would expect that we're probably going to stay range bound in here as the news just continues to be the same for Tesla. What else do we have here? Meta down 4% today. It's in a bit of a downward channel. Again, just touching on its 200-day moving average. Microsoft below its 200-day moving average, below its point of control. So there could be opportunity for these for bullish plays. Not a huge amount of volume in these levels. See down here. So there's typically quite a bit of velocity when we see low volume. Now this is going back quite a few years. I'm scrolled out quite far. So typically, if I'm going to look at volume candles, I look at them on a slightly shorter time frame. And so this is looking at the last 15 months. We can see lots of consolidation on Microsoft, very, very close to its fair valuation, maybe a little bit low right now, so might be opportunity there. ARK-K had an awesome year last year, came down. We can see that this channel that it's been trading in very much at the bottom of that, right near its 200-day moving average, well above its volume area. And so we could, if it gets some traction, lots of, Kathy Wood has lots of small cap stuff in this, and lots of Tesla. So this correlates heavily to that as well. Could we see some upward momentum? We might see some downward. And again, I'm playing quite neutral on all of these positions, just trying to keep my deltas in check, keep my theta positive, and just keep that cash flow coming into my account. William says Seattle, Washington. Good to have you here, William. David says, God bless Canada, brother. Australia will come and defend. Okay, thanks so much, David. We're doing what we can up here. And Mike says, hi, Canada. Thanks. Appreciate it. Appreciate all the support for those of you who are supporting us from around the world. I'm just looking out my window because it's feeling very spring-like here suddenly, which is great. I got my barbecue open the other day. I know in some countries you don't even have to close your barbecue, but my outdoor kitchen gets kind of winterized, and I don't have the sink on yet, obviously, because we're still quite cold here. But I got that open the other day, did some beautiful steaks, pretty excited about that. Pool next month is going to be great. So it's a good time to be in Canada. We're getting into these longer evenings. I would love to see some tickers. I'm going to pull up Seeking Alpha. We're going to take a look at a couple of different stocks. I know Beyond was asked in the questions. John was asking about Beyond. And why is that not coming up? This isn't it. What's the beyond? What is, I'm sorry, I'm a little confused. Why does this seem incorrect? This is gaming, but casinos and gaming. But what is the car company, the EV company? So somebody jump in and remind me what the ticker is, because that is, I don't think that's quite right. I'm gonna look here. I know what it is. It's on the tip of my tongue, but I can't seem to think about it. Boyd Gaming we'll take a look at right now, just because that's the ticker that was posted. Fair value $73, upside at 8%, $68 right now. Impressive gross profit margins. Here's the market range, trading between 81 and 49 over the last 52 weeks. Analyst targets are $84. We're trading at 68 right now. There's a consumer discretionary. There's a consumers or casino type play. Kind of interesting. I wonder what the options are. It's a Chinese company. Is it not? I feel like it's listed. I feel like there is a U.S. exchange for it. Let me go to Yahoo Finance and pull up Yahoo Finance, and we'll take a look there. I'm familiar with the company, obviously, but it's not on my radar to trade, and that's why it's always good to have these. Oh, that's not what I want. Sorry, I was trying to get to Yahoo Finance, and always good to have these discussions, because then we get to look at different things. So let me look for BYD. Says it's private. Okay, I'm not going to make you guys wait there. Do you have the ticker for the on the Chinese exchange? We can look it up. I just don't know what it is. So BYD doesn't seem to be the one. Is there any other tickers you guys want me to look up? I would love to. That would be fantastic. Some of the things on my mind right now, things like Exxon, would just where the oil prices of oil are. You know, these plays, looking at the last year, were 1% on XOM, on Exxon, and these are the types of plays, like I see people holding these like dividends in their portfolio. Like, this is a great little dividend play. If we look at, where's the dividend on this? Dividend date, February 12th. Oh, here we are, 3.96. So an investor might look at something like this and say, okay, well, I'm going to trade this and I'm going to hold this in my account, make this 3.96%, and then hopefully make some money on the appreciation of the stock. And of course, over the last 5 years, it's done very, very well. But for the most part, shares like this oftentimes have lots of potential to the upside. And when we look at the option pricing on something like Exxon, if we look at the calls and we go out to April, and say we were holding these positions, and the stock's trading at $113, selling the 120 call collects about $1. So from the perspective of how can we create more cash flow, creating $1 of cash flow, or $12 per year on a long hold position like this, if we go back to that chart, if we were to look at this 5 year, over the past year, the stock has only traded at that 120 mark, above that 120 mark a couple of times. And when there's always potential that it could rally up, I prefer taking at least some of my positions and selling covered calls against them, because I think that in most cases, these can be very, very good. If we look back at the last 2 years, stock was trading in 2022 in November at 111. So obviously this was a huge rally off of a down move, because remember, oil prices went way down. If we go back further, like looking at the last 5 years, you're like, oh, this is up 245%. But that's only if you entered at this bottom of 2020, which is often when people are selling. If we look at Exxon over the past multiple years, And I don't think this is showing splits in here, but this is an $89 stock, you know, not $85, $86, 96, relatively sideways moving company. Obviously we have to eliminate, I don't like this, this little box that's going on here, but eliminate the down draw that happened. We wouldn't sell calls in those time frames when the portfolio is getting crushed. But for the most part, stocks like this, it's a great time to perpetually sell calls on long stock holdings while we're collecting a dividend on these. And I feel bad for people that miss out on those opportunities because they're just trying to be dividend investors. And Exxon is one of the ones I've watched for years and years, and it has a pretty consistent selling out of the money calls for that, you know, 1% a month, which is making 12% a year extra is fantastic. You know, that's a fantastic return and very simple trades. Powell, what are my thoughts on Powell speaking tomorrow? What is he going to say? Is there anything exciting going on? I mean, he's been saying the same things all week. The economy is good. What we're seeing is the movement of money from sectors to sectors. We saw like healthcare has taken a huge boost. We've seen real estate obviously taking a boost. Utilities, the inflow into utilities hasn't been huge, but all of this money has been coming out of tech sector and kind of into these more stable recessionary stocks over the last couple of months. But what we're not seeing is a huge outflow of money out of the market. And so overall, the economy seems to be pretty good because we're not seeing cash reduction from the levels. Really, as traders, we have to decide where are we going to try to chase that. Are we going to try to flip our money just like the hedge fund managers do, or do we continue to just stay neutral? One of the things I'm doing is I'm concentrating on the sector, or not sectors, the ETFs. I'm like concentrating on things like SPX, RUT, NQ, NDX. So we're looking at, you know, valuation plays and saying, well, where do we think they're going to go? Today, I put on a trade on NQ. I don't have NQ here. Put it on QQQ, but like they're massively wide. We can play ranges right now that are near the tops and just capture this and say, you know, for the next 2 months, do I think that this stock is going to trade in here? The other thing that I like to do is I like to build profit tents. So I actually build my levels down in these lower areas and say, I'm going to make more money if we drop into this level, if we have a continuation of this trend. But this is the range that we're putting in. And I've drawn this box way too big. I'm only going out to like May 15th right now. I did one for May 29th. So it's not even as large as that, but it's about that wide. So if I was to redraw this, let me just X this off here. If I was to redraw this, the range that I am putting on trades right now that's the profitable range with a little kicker down here. And we can do that same thing on NQ, or we can do it on like RUT. And so if we look at RUT, we're doing the same. What was the level? I was like a 2268, I think was my top of my range. So my profitable range from now until May 16th. So that goes out to here. And I was at 1778, something like that. So let me just mark these on here. I don't have them on. My top line was at 1660. We're at 2268 was my upper break even. And my lower break even was 21. What was it? It was, let me just look. It's my lower break even. Just to give you an idea of what I'm looking at and how far I'm going out. No, lost that. That's moved already on me. Didn't have it entered yet into my sheet. It's way down though. It's way down here. 17. Oh, I know where I can see it. Bear with me. Pull it up here. Too many trades on. Here we go. Break even on this is 1761. So if I was to put this on here, 61. So there's the break even range. And this is for expiration May 30th. So we'll put the end, we'll put a vertical line on here for May 30th. And let's move that over to May 30th. Okay, so that's my target. Anywhere in that box, right there, is profit zone. Doesn't that seem great? Like, isn't that a great way to be putting on trades? I feel like it is. I feel like I'm pretty happy with that particular style of trading, and we're getting nice and wide right now, and that's because the VIX is high. And of course, if you guys are interested in seeing those specific trades that I put on, you have to, in our members only area on Patreon, this allows me to do what I'm doing and pay for all the things that I have access to so that I can do the research and make sure that everything is out there so that I'm making informed decisions. You guys get to join the community. You get to talk with people, pitch trade ideas. We get to review the ideas together. We do a live session on Thursday. It's pretty great little members area. So if you're not already a member, I know there's already members here. So I'm speaking to preaching to the choir a little bit. Okay, let's get on to a couple other stocks. Do we have some symbols in here? Jackson says, oh, we'll look at pins. Yeah, absolutely, Brian. Let's take a look. In answer to your question, I'm not worried about Jerome speaking tomorrow. I don't think it's going to be anything crazy. I think he's going to say the same things that everybody says. Pinterest at this level, $31. Again, these are stocks like I play Pinterest a ton, and typically I play it a little bit long. And what I do is I look for entry, and I like to enter when it's right around that 20, 29 or 30 level. And this is over the last year. If we look back in time, Pinterest, has been a very static stock. And there's decent premium in these. So depending on what you want to do, there is the premium for sideways trading is great on a stock like this. I like it quite a bit. I typically, because it's low priced, because we're only $31 or $3,100 for 100 shares, then I am typically looking at playing naked put positions on the downside. Or if I want a bit of delta exposure, what I might do is do like a leap in here. So to do leaps, what I will do is I sell very short duration calls. Let me just change this up. If we look at the straddle price here, next week we can collect $32. We can collect 58 cents for the 32 strike, selling the 32 call for next week, which is more than 1%. Typically, if I think that the stock is going to go up, what I might do is I might go out to January of next year, June maybe of next year, so that I'm further than a year out. And for $900, I would buy a call. So $920 outlay for the 28 call. And then I would start to sell positions against this. And I would, take that 58 cents. If I want more deltas, then what I do is I play either further in the money, I spend a little bit more money, that gives me a longer delta position, or I play multiple long calls against lesser short calls, or I do the short duration as call spreads. So let's walk through a full example. I might buy the 28 call for $920 for June 18th of 2026. Then on the short duration, I might go out here and I sell the 58 call. And so I'll just mark that, sell that, and I collect 58 cents for doing that. Now the hope is on a trade like this that the stock goes up. It's a long delta position. So I want Pinterest to go up, and I want it to be trading above $32. That would be ideal. That would push me into my max profit range. I would be able to sell off the leap and buy back this short call, and I would profit from that trade. If I thought that Pinterest was really going to go up quickly and I wanted some long deltas, but I didn't want to pay for all that theta decay, then what I might do is I might sell or buy a 33 put. What that does is it gives me 18 cents of total collected credit for the week. So I would sell the 58 and I would buy the 30. And that what that would do is it would just give me 18 cents of credit to offset the fact that I'm holding a long call for the 28. Now, if the market goes up and say Pinterest goes to 35, well, now I've only capped out $1 of that gain. And this is a way to make an extremely large amount of money quickly if we're right, if we're directionally correct. Typically with Pinterest, I'm not looking for that, like that get rich quick to the upside. I want to just churn out the short duration, 58 cents for every 10 days. If I can make 58 cents every 10 days, then the stock just trades sideways. I can make a very, very decent premium and make back my 920 bucks in a pretty short order. It only takes about 3 months to gain back everything, and then it's just free from there. So that was some trade ideas for you. So Pinterest, let's look at, we looked at the summary here. Seeking Alpha, oh, sorry, I went off that screen. Seeking Alpha quant rating is a buy at, oh, sorry, my screen's being funny. There we go. Seeking Alpha rating here. Valuation is a D, so it's still a little bit overpriced. Growth is an A, profitability is an A, momentum is a little bit poor. And again, this is why I trade neutral trades, because it's got poor momentum. But it has possibility of shooting up, which is great. Let's compare that to Yahoo Finance doesn't have anything. Let's compare that to investing.com. We'll just see if I can type here. Pinterest. Take a look. Fair value 37.36, 19% upside. This is where we may want to consider having some long deltas, because this calculation is below the fair value. Seeking Alpha showing it above. So interesting. A little bit of conflict there for these quants that are basically algorithmic trading, or their algorithmic analysis. So it's good to compare multiple things. Jackson Tate, just because I know it's important info, I want to tell you that I've had Burger King twice in the last 3 weeks, and both times were amazing. I think RBI has been watching your streams. Oh, I hope so. That's good. I am so glad to hear, Jackson, that you have been enjoying some Burger King. I don't know if you guys remember the stream a couple weeks ago, but like we talked about how it was the quality has not been very good. So thanks for the update, Jackson. That makes me so happy, and maybe I should go and get a Whopper. It has probably been more than 5 years since I've had a Whopper, and should I get them with or without mayo? I'm not a huge mayo fan. And sometimes those burgers can be a little sloppy, but I do like the onions they put on, so hard. Nasir's asking, can I give us an example of what are you asking about, Nasir? An example of long deltas or a neutral trade? Maybe we'll talk about neutral trades, because that's kind of what we were talking about before. Let me just pull up here. It won't even pull up these indexes. Let's go to QQQ. And we'll look at, I'm not using the IBKR right now just because it's been not very nice to me. If we were to go out to May, which is pretty long right now, say May 16th, we're getting out there in time. Doesn't have the days to expiration here, but from May 16th, we are how many weeks? That's 30, 73, May 16th is 45, 52, 50, about 56 days. So we're 59 days, I think we are, to May 16th. So if we were to put on a trade typical in high IV, what I normally do is I look at the delta values. And if we were to look at Qs, I know this isn't on the screen, but my IBKR has been terrible during these streams. So May 16th, 59 days. If we were to look at the 425 strike, so I'm going to just scroll this up a little bit. The 425 strike, I'm going to write on the screen here, and I'm going to try not to move it. this is kind of the sweet spot. So typically when we're setting up strangles, normally people are going to sell those options. So I'm going to, what am I going to do? 425. I'm going to highlight this orange. And so you guys can see that would be the strike to sell, 425. The reason that this is the strike to sell for this duration, 59 days, is because the delta, and your platform will tell you this, is 15.5. So it's right around the 16 delta. 16 delta is the one that we're typically targeting. Now on the call side, the 16 delta is the 517. It's off the screen. And this is how nice and wide these are. So it's actually below these levels. So let me scroll this up just a bit and see if we can get in here. Yeah. So there, I'm gonna mark some on here. So the 425 is the 16, and then the 517 is the 16 on the call side. So that's a nice wide strangle. Now, some people, what they do is they will sell a 24 delta. So let's talk about that for a second. So this is gonna be puts, calls at the 425 and the 517. If you wanted to be more aggressive, you would sell, why don't I just pull this up? I'll pull this up right here. You guys can look at it. Just give me 1 second. Pull up the whole chart because I actually have this. Come on, really? Give me that many gears here? And bear with me. What time is that? I gotta pull it off my computer. It's one of those days. 9:20. When did I do that? Okay. That's IWM. Let's look at the QQQ. All right. It's coming to you. It's very, very close. I'll show you the exact trade. I put this on in my Discord this morning. You guys can take a look. I'll show you exactly what I did. And then we'll talk about why I did it. Okay. So let me zoom in here a little bit. And so this trade was put on this morning. QQQ was trading at 473, and I chose some strikes. So this looks complicated, but it really isn't. And I'll walk you through exactly what I did. So the first thing that we're looking at is we want to sell some sort of premium. So the 430 is the strike that I sold. Now I talked about the 16 delta. That's pretty typical. We can sell anywhere between the 16 delta and the 24 delta. So that would be between the 440 and 425. That's pretty typical of the short put that we would select. Now on the call side, the range is much wider. The 24 delta, as you can see, is the 507, and down to the 15.5, which would be 518. Now that gives us our expected range. We can also see on IBKR, if you see there's a little bit of a color difference if we look at the strikes in the middle, shows this darker blue portion here, and then at 519 it jumps to a slightly lighter blue, and above 430, 425 and above is a slightly lighter blue. So that is our expected range. That's the 68% standard deviation range. And typically when I'm opening a strangle, what I want to do is be delta neutral. So I want to put on a sell at the call on the top of that range, and I want to sell a put on the bottom of the range. Now, with the downtrend happening, I wanted to add a little bit more protection to this. So there's two things that I do. The first thing that I do is I don't just sell a put at 430. You can see what I did was I actually sold two of them. So by doing that, what I'm able to do is I'm collecting double the credit. I'm collecting 539 twice, and I can use some of that credit, that total credit, to buy a 440 put. And what that does is it creates a position called a ratio spread. So I have one long bear put spread, and I have one short put. The short put and the short put of the bear put spread happen to be at the same strike. So that is the upper portion, and then the lower portion, you'll notice this is $10 wide. On the call side, I only did $5 wide, but I did the same thing. I bought a 510 and I sold two of the 515s. What that does, you can see here, sell to May 16th, 515. I collected $3.48 twice, so about $700, and then I paid back 456 bucks. So I'm still net positive 256 bucks or 250 bucks approximately. Then what I want to do is I want to have a little bit of short delta bias. And if you look at this overall trade, the delta on this is negative 0.046. And what that means is that I have a position that makes a little bit more money if the market goes down because we're in a downtrend. And what I'm doing is I'm buying another little spread in here. Now this spread isn't huge. It's a $5 wide spread and I'm paying about 75 cents for it. So it's pretty cheap relatively for what it gives me, because what it does is it brings my break even over by another $5. It gives me $5 more protection. And if I turn myself off, you can see how wide the break evens are on this trade. I've got them marked here in white, and the expected range is this blue cone. And what I'm looking at is saying, well, I want to trade on the outside of that. I'm collecting 500 bucks right off the top. And I have this nice wide range. I've got some bear positions built into this. I have a slight bullish position built into this, and I'll be able to adjust this up. Now, I did a video years ago on taking strangles and adjusting into straddles, and when our positions get tested. Now, by starting wide and by starting with this long duration trade, which is 59 days, my expectation is that I'm going to be in this trade for about 40 days. So as time moves, I will move those short puts in or out, depending on which direction we get. The whole point is, I hope that we just trade sideways. That would be ideal. Everything just decays. I make my 500 bucks over the course of the next 40 days. I make the majority of that and I close the trade. But if it starts to move, I'm going to treat the base portion of it like a strangle. And if we're moving to one side, it's moving into one of my profit tents because I have profit tents on both sides. I'll show you what the trade looks like. Actually, we'll take a look at what it looks like. I'll just do a screen grab of that. And sorry, I wasn't prepared to show these things. These are in my live chart. So for anybody that wants to see them, they can just go over and, but of course, that's out of sorts because I just entered it this morning. Where is my trade? These usually get sorted at the end of the day. My apologies. I wasn't planning on doing this. There we go. There it is. So this is what the estimated profit loss chart looks like. Just bear with me for one more second while you guys look at that screen and try to decipher what it. You can probably imagine what it looks like, but I'll show you exactly. And so here's a. This is what the chart looks like. So it very much represents a strangle in that it has maximum loss to the downside and it has maximum loss to the upside. If you guys aren't used to rating these profit profiles, the stock right now here, this is my rolling options record keeper. What it does is it tracks the movement. So one of these red lines will be the opening price and one of them will be the current price, and then the current price obviously updates every 15 minutes and moves around throughout the course of the trade over the next 40 days. Stock price movement, so at March 18th when I opened this was $4.74 a share, and now we're trading at $4.75.34. So it's actually moved up 34 cents. Now the reason I build the trades like this is because I have a huge amount of potential to the downside. I could have opened a strangle in a different way, and that strangle, if I had done that, I would have collected $539 for the 430, and I would have collected $351 for the 515. And what that would do, it would give me $800 of premium. So my profit tent would actually look like this. But the thing is, if I did that, the peak would be at a slightly different place. They wouldn't have these wings to the outside. That would be at 430 and 515. So if we were to mark this on here, this would start to decay here. at 515. And then at, what was our other level? We were at 430. So 430 is right about here. So if I was to draw this in, we have to ignore these little legs, but that's what a strangle would look like. We would have a substantially higher break even on the put side, be around that 425 level, maybe slightly less than that, but around there. And I would have a max profit tent here. What this does is it allows me to have a large profit tent to the downside because I have these built-in bear hedges. And I think that in this current market, when we're seeing a shift to the downside, I think that these trades are optimal, because if we do get a market move down to the downside, it's actually moving into a large profit tent. And what I would do in that case is I would move my call side over to tighten it up. If we get a move to the upside, I will move my put side up. Now, this trade is a little bit lopsided. It does have short deltas, but not a huge amount. Again, we're looking at this, and the whole point is to stay delta neutral. So in this case, the deltas right now are 0.04 to the negative. So just very, very slightly delta negative. And again, operating mostly like a strangle because we're high IV. Hopefully that makes sense. I know that it's hard to follow those things. Whoppers were $5 in January. I hope that helped, Nasir. Whoppers were $5 in January. Wow, man, it's like the prices. Let's not even talk about inflation. It's just getting expensive. If you guys could throw out a couple more tickers, that would be fantastic. I would love to see what you're looking at, and I will pull them up. Seeking Alpha, Investing Pro, and we'll look at the ratings. Oh, that tea is like perfect temperature. I'm gonna pull up the screens right now, and I'm ready for typing. So you let me know what symbols and I will type them in, and we'll take a look real time. I love this segment where we get to just look at as many stocks as we can. So as fast as you guys can type in the comments, QCOM, which is Qualcomm, and 12%, 12% upside, fair value at 177. So this is one of those stocks that's been beaten down. A few of these are coming up. This Petrovsky score of 9, which is interesting, but buying back shares, trading at a low price to earnings ratio relative to near-term earnings growth. Remember, when we're looking at fundamentals, I think these are good times to be buying stocks like this. So who else has one to pull up? I'll look on Seeking Alpha as well. Qualcomm. These ratings do change, so it's good to just review them all the time. Valuation is high, a D plus here. So again, this is where these two services are actually not congruent with one another. Yeah, Costco. Let's take a look at that. What I like to do is find when they're together, when they're both saying the same thing. Valuation's an F. So profitability is an A+, which is fantastic, and momentum is good, but overall, the valuation is still very, very high compared to its. And we would often see that by just looking at the price to earnings ratio, like how much we're paying per dollar of income. So forward projection 50 price to earnings ratio, and we're looking, typically for buying around 20. PE if we want to get a good valuation on stocks like that. We'll look at Costco over here, and I would assume that this is going to say that it's overvalued as well, which it is. Fair value 690. So this is where we want. If I was trading this, what I would do is I wouldn't short it. I would take a short delta neutral position on it, because there's obviously a reason that the stock is at $900, and when we see these fair values that have 23% potential to the downside, that what we can do is we can then load up a trade and take a look at the options. So we'd have to know when the earnings are coming out. Announcement date is March 6th, so that's already passed. That's fantastic. So if we look at the options chain, and again, going out, we could do May 2nd right now, which is, what did we say? May 2nd is 59. So around 45 days. So yeah, so this would be the good range to go for. That 600 600 put. Let's look at the price of that. We've got no bids. We don't even have bids around that fair market value. Let's look at Costco. So 690 fair value. So around the 700. I was lying to you. 83 cents. Not a lot of premium there. There's not a lot of risk to that. So we have to play much closer to get decent amount of premium. Now, for an $800 stock, this is an $80,000 position. I would typically want to collect about $8 on something like this. So I have to trade all the way up at the 830 to make this 45 days out to make 1% return. I may not want to do that. And this is where looking at these spreads and saying, what if I did play that 830 and I collected $9, but I was able to buy a spread in here. What if I bought let's just change the colors here. What if I bought the 840? I buy one of the 840s and then I sell two of the 830s. And what that does is it's going to, if I do two of these, so this is times two, then that is going to give me $1,800, and then I'm going to give back $800 of it. So I'm still going to collect $1,000 right off the top. Sorry, 1,800 minus 8. Yes. How is that? How is that the case? That's my math must be wrong. 2 times 9 is 18. Minus 8 is still 1,000. That I don't know what's going on. It shouldn't be that. It should be $100 less, because we're basically paying $100 for the other spread. But wow, those seem super tight. So you'd have to load this up in your brokerage to see. But that would be crazy if you could get that. If you could get $1,000 for selling two of the 830s and buying one of the 840s, which I don't think you can. But if you could, then you have moved the break even over by $1,000, created a large profit tent, and you've actually collected more premium than just selling a single short put, which is impossible. So I'm not really sure how that's working out for me, but it should be $100 less. Yes, thank you for typing in some tickers. I love it. Let's look at, I'm just going to go through these. ASTS, and which is ASTS Space Mobile. What is this? And what are the premiums? So Wall Street says it's a strong buy. It's not profitable, which is a huge red flag, especially in inflationary times. Momentum is great. See Michael Wiggins, he's one of my favorite analysts to follow. He's got a hold rating on it, but valuation says C-, but lots of growth, but not profitable. Stocks trading $35 for kind of the last 6 months or so. On the 1 year, up 794%. I'm just going to quickly look over at I'm going to move this too. Move that like that, so we can just go back and forth, and then we'll take a look at ASTS. We'll look at the rating here. So fair value of 1987, stocks trading at $26, 25% downside. You can see the range. Holds more cash than debt on his balance sheet. Interesting. And volatile movement, which we can always expect from this type of thing. I don't even know what this is, but it says it's communication service. Oh, so this is like space telecom. Cool. Like it. Let's look at the options chain. You don't need anything fancy. We just need to know some basics and some basic math. So when we look out here at May 16th, we're 45 days out. What I'm looking at is, can I collect some money that is reasonable relative to the stock price? So if I collect $19 for a $10 strike, that is $19 per $1,000 invested. That is a 1.9% return if the stock stays above $10. That is an incredibly large amount of money to be paid. 1.9% for selling the 10 strike. So there obviously is some risk there. It may go down that below $10. And we saw that fair market value calculation, which is why I always like to look at that. So we've got that 1987. What if the stock was trading at $20? How much can I collect here? Well, this for a $2,000 investment, I'm collecting 190 bucks. That's almost a 10% return. Now, the cool thing about this is that we can actually put ourselves in a position where we have very, very little risk and tons of potential. So let's take a look at what we might be able to do. Say we were to spend $110 here, or sorry, collect $110 and say that we're going to buy the stocks for $17.50. Can we use a portion of this money to buy a bearish spread? Well, I think in this case, definitely a possibility. So we could buy the 20. I got the wrong color on there. Let me do that. Buy the 20 and sell another $17.50, and that's going to cost me about 80 cents. And what that does is it again moves my break even over further. So if I collect $110 and then I spend 80 cents of that, I'm still collecting net 30 cents. Net 30 cents on my risk at that point, which is only going to be $1,500, gives me a very, very high return on valuation. What I do is I ratio these. So I might sell 3 of the 110s, collect 330 bucks, and then I buy one $20 put. And so if that price goes crashing down and goes to that fair value level, there's probably going to be buyers there, and because the price is going to be cheaper, but I'm moving into a profit tent. If it really goes down, I've at least get another 250 bucks in my pocket, and I'm rolling a 200 share position. Now, the other thing I could do is do a butterfly. I could just do a little butterfly in here and protect some more of that position. So what I would do is buy a 30 put. So just to be clear, I'm buying one here, selling and buying one of these, and then selling three of the 1750s, and that gives me 330 bucks minus 90 minus 130. I'm still collecting about $220 minus commissions, and I have a profit tent, and now I only have 100 shares at risk. If the stock went to 10 bucks, I would be on the hook for buying some at 1750, which is like 40% lower than the current valuation. Now, there obviously risk in trading these. We didn't even talk about the upside, which is where there could be a lot of potential. So what I might do is I might put in this agreement, which is creating positive theta decay. It allows me to buy some shares if it drops down, or make some money if it drops down. But what if I want some upside as well? In that case, that's where I would use that leap strategy. I would go out to next year, I would buy some calls, and then I would sell some short duration calls against it, and I can layer those up. And it's why I like these complex types trades. Cool little one. Thank you for John for bringing that to my attention. The nice little premium in there. Obviously, we have to look at the earnings date too. And so the announcement date, March 30, and beat by 5 cents. They're still negative, but that's fine. You know, they're barely negative. Once these companies flip, you know, you kind of want to be on top of these when they do flip to being profitable. So if you were to look back, one of the things I like about Seeking Alpha is it shows the actual profitability. And so in this case, they were profitable, and then their earnings release came out and they were not profitable. So we want to be on the flip side of that. We want to be in companies that are going from negative profitability to positive profitability, because then there's a lot of potential that happens when that happens. So if we were to look back at like August, when this went from a C profitability up into an A, I bet there's a correlation between stock price increase. And we can see what was happening here when we were trading at 31.36, it was a C, and all of a sudden it was profitable. We're at 31.03, and then the next day the stock jumps over the weekend to 38.60. And that is where we want to be. So it's not necessarily that it's a bad time to put on a trade when they're not profitable, but we definitely want to be on the side where the stock flips from non-profit to profit. That's where we see extreme moves. So something to think about when you're doing your research on what stocks you're looking at. Let's take a look. What is going on in the market here? We've been online for a little while now. Let's just take a look at the SPX and see what's happened over the past hour. We're gonna go to the 1 minute chart here. And we're still staying in that consolidation range. We moved up very, very slightly, but pretty inside day off the first half an hour move. You know, by half an hour in, this is where we were trading, and I would expect we'll trade the whole day. Point of control is still above, so if we do have a move, my guess is it would be slightly bullish to the upside. You know, we might trade in that range. We may not. I don't think we're going to break the lows of the day. If I was charting this out for today, I would say that we're on a slight uptrend based on the fact that we're getting these higher lows, and we're seeing repeated in a line. So my expectation is we'll continue to bounce off this average, and we'll move up to finish the day. But you know, we're only guessing. You know, that's my educated guess from watching a lot of these technical charts. I've done a lot of 0DTE trading. It's not something I do a ton of. I do have a very specific trade that I will enter if the parameters are right. But there's some people that do a ton of 0DTE stuff. Not really my thing. I don't like the stress. I like to just do these long-term trades and have these wider ranges. It works a little bit better for my comfort. What else were we looking at? AAL. Who's asking? James. Okay. Keep waiting for my buddy Rich to be back. Whoa. Down at 11 bucks. I'm glad Rich got out of this position. He did very well on it last year, and you know, after much discussion, he exited that position, and now we're down at this $10 level. You know, okay, I'm just gonna give you my overall thoughts on airlines, because this is what I think happens with these airlines. The governments are subsidizing, at least Canadian airlines, they're subsidizing our airlines in general. So when we have ridership down, how do these make money? They make money off taxes. So we have to look at like what the government inflow is. And I'm kind of, you know, generalizing this in general, but that they've always relied on the governments to support them in times of strife. I'm not a huge fan of trading airlines for long-term holds. Just that's why I am saying that, because I think that they're a business and an industry that is supported by governments rather than on their own choices and things that they do to make the businesses stronger. Now, it doesn't mean that this isn't potentially a really great time to buy. Again, they are profitable. So price is definitely down in a low place. Is it the best? I don't know. Here's the ranking. It's ranked number 15 of 26 in this industry of passenger airlines. Interesting. Let's just look at the top ones. So here's International Consolidated Airlines Group. $7.65. This may be a better play for our money if we were to look at things. No options. So I know James is a fervent options trader, and he likes to really kind of mitigate his risk. So AAL definitely has what we need for in terms of we're going to go back to this in terms of option premium, because there is tons in there. And if we look at the short duration, if we were to just go out, you know, even on a bi-weekly basis, if we were to look at how much premium there is, we can see that we're getting 32 cents for the 11.50 call. That's tons of premium, you know. So we're out of the money, 32 cents. We're getting, you know, almost 3% return just selling the call against any shares that we purchase at this level. And again, if we wanted to do leaps, this would be a great stock. If we went out in time to say next year or even later in this year, December 19th of 2025, if I was to buy some 10 calls, I'm only paying $2.90 for it. So the valuation for that 10 call, which is $1 in the money, if I pay $2.90 and then I collect 32 cents for selling a call against it, I've got $1.50 wide positive spread to to my benefit to the upside, and very little theta decay. My total risk is very, very small. It's $260 total risk to open that leap trade. And I've got the potential of making over $150 on it. So I can make a 50% return in potentially the first week, effectively, first 2 weeks. So lots of potential at these levels. If I was going to trade these types of products, that's how I would be doing it. I would be using leaps, and I would be looking for that very quick theta burn on these positions. Now, when is the earnings date? We've got estimated earnings here. Announcement date was 1/23. So we'll have earnings again about a month from now. So we do have to pay attention to that. But we can see beat by 20 cents on the last earnings. Oops. If that makes sense. Okay, a couple more RTX. And then James, I'm sorry, I don't know why your message was retracted. That's not me. Please type it again, maybe in a slightly different format, and we'll hopefully you can copy and paste, and we'll see what you were trying to say. Because I would love to know. I always value your input, so I appreciate you being a patron for so long. Strong buy RTX, quant rating is a 4.69. Very, very good. What is this? I always feel slightly embarrassed when I say that, but I just don't know. RTX Corporation. I don't know what they do, but let's look at the valuation is still a little bit high. The growth is good, but they're highly profitable. They've got good momentum. They're aerospace and defense, and they're in industrial, and ranked number 4 out of 57. I like it from here. Let's find out what their fair value is. Great ideas this week. Thank you, everyone. This is fantastic. Fair value of 127. So not bad at all. Like, this is right in its current range. Raised its dividend. We've got a relatively low P&E, and stock generally trades with low price volatility. This is fantastic. Are there options on here? Let's, is there a huge upside potential in this? Because if there is, okay, let's go to earnings first. January, so we got earnings in about a month, so we have to play pretty short, but yeah, this is good. 132, get $1.33 premium, collects $1.20, and so that's at the money. Not a lot of upside potential here based on those valuations. That is that's this week. Yeah, there's lots of upside potential. So looking at the April 4th calls, the 140 gives us 45 cents. The 136 gives us $1.46. So again, this is where what I might do is I might sell something like right at the money, sell the 132, which is slightly in the money, for 337 collected. And I might sell like 3 of those and then buy 4 leaps. This would give me a long delta position in this and just be able to pay with this short theta decay. So 337 times 3 would give me about $1,000 in credit if I sold 3 of those. And then if I went out to, say, January of next year, how much does it cost to buy the 130s? Cost me $14.50. So I would buy 4 of these. $14.50 times 4 would give me a $3,000 output minus the $1,000 that I collect. And I would have a $2,000 total risk out of pocket. I would have a long 100 deltas at that point, around there, probably like 80 something deltas, and tons of theta decay. So if I was looking for a breakout position, that's what I might do. If I was more conservative, then what I might do is just go to that shorter duration, and then I would just sell a put and say, okay, I'm willing to buy these shares, but I'm going to buy them when they're at a even lower valuation. And again, looking at this, saying fair value is 127, I don't mind paying that. So I might sell the 128 and collect $132. 2 weeks out, that gives me 1% return on capital. So pretty awesome, just selling the 128 put for those conservative investors, knowing that if I am if this stock goes down, I have the chance of losing, $12,800. And again, I could do a ratio spread in here as well. Only 10 cents to buy, it's like 9 cents to buy a $1 ratio spread, or to buy a $1 spread in here. So it's really, really cheap to do that. It's very smart to collect 132 and then spend 10 cents to buy a $1 spread and move that break even over just another $1 and give yourself a profit 10 to the downside. I really like those ratio spreads in high IV. I think they're underutilized. Anytime I'm looking to sell a short put, I'm always looking to ratio it out. So I'm using a portion of it to buy a little bear put spread. Hopefully that makes sense. Okay, you guys are amazing. I am going to cut it out of here because we're already over an hour. Thank you so much. Brian's asking, how far away from earnings do you like to keep your trades as a general rule? Do you just make sure the expiration date is a certain amount of time after earnings? Unless they're in earnings. So if I'm playing the earnings, then the expiration date is after earnings. And that can typically be anywhere between like 3 and up to around 17 days is my kind of typical. I like to play them. If I'm going to play earnings, then I play them very short duration. If I am doing a non-earnings play, which is what I typically do, I try to avoid earnings. I want the expiration of the shorts to be prior to the earnings. I do have risk sometimes when it's too close that the earnings announcement could come out early. That rarely happens, but there is risk of that. So something to consider when trading anything with earnings. But generally, my style of trading, all of my option contracts expire before earnings. And I generally don't play a lot of earnings because we make some, we lose some, and it's just a wash. It's just extra work. And then the only people making money out of the brokerages I've found, and I've been doing this for years now. So Mike says, I've been considering leaps on AAL myself. Yeah, I think that at that level, we're getting very, very close. James says AAL is just a fun little low price stock with high volume, easy to keep the position size small. Absolutely. And that's the way to do it. Like, don't kill ourselves with loading up on those tiny things. We saw over the years, I've played AAL quite a bit and I've played it very well this year. I got out of all of my positions before this down run. So I've been happy with it. At these levels, I would be happy to look to get long again. Just, with all those caveats we talked about before. Okay, you guys are amazing. Thank you so much for all the support. I hope you enjoyed the video. Thanks for the comments. We'll see you next week. I'll see my patrons on Thursday and we'll see you in the chat room. Take care.